The objective of stock market narratives is to explore past situations where stock valuations were highly impacted by the narrative. As a result, our followers may be able to spot market forces influencing valuations and hopefully help them become a more aware market participant. In the short term, markets tend to trade based on narratives. When a narrative is overly positive, the market and media project pie-in-the-sky growth while ignoring the inherent risks to the business. When the narrative is overly negative, the market underappreciates the fundamentals and long-term value of the business while exaggerating the potential risks. Prior to April 2018, private companies like Open Door were raising capital from firms at lofty valuations. Zillow may have viewed these companies as a threat to their core business and announced Zillow 2.0, their entrance into the iBuying business. On April 12, 2018, upon announcing Zillow 2.0, Zillow stock dropped 9% due to investors being worried about the additional risks and thin profit margins from the iBuying business. A little over 1 year after Zillow 2.0 was announced, there was still very little enthusiasm from investors. You can see from this excerpt, although there were a lot of eyes on the iBuying industry, the market wasn't overlooking the fact that the industry was saturated with many competitors and margins were razor thin. This chart reminds me of one of my favorite Warren Buffett quotes. For some reason, people take their cues from price action rather than from values. Price is what you pay, value is what you get. Although Zillow was losing $6,400 per home sold, the 25% single-day rally after Zillow reported Q4 2019 earnings in February 2020, RBC Capital Markets was inspired to raise their price target by almost 50%. This chart is illustrating a significant 30% jump in Zillow's valuation from September 8th to October 1st, 2020. Analysts were increasing their price targets mainly due to enthusiasm for the iBuying business. Comments from Zillow's Q4 2020 earnings in February 2021 provided confirmation bias to investors and analysts that since Zillow was aggressively investing in new technology and services to capture the iBuying marketplace, the pie-in-the-sky growth was real. On February 16, 2021, Zillow's stock and valuation peaked at $208 per share, valuing the company at around $52 billion. Keep in mind, Zillow's annual revenue was only $1.7 billion, and although their core business was generating about $300 million in EBITDA, their iBuying division produced a negative $250 million in EBITDA. These analysts are so enthusiastic, specifically about the iBuying division that was losing a ton of money. These excerpts from May 19, 2021 illustrate that since Zillow's stock was down 50% since February 16th, people started having concerns about earnings relative to the valuation. October 19, 2021 was when the narrative really lost steam. When Zillow announced that they would stop buying homes for the rest of 2021, the market sold Zillow off 10% from $94 to $85 a share. While following publicly traded businesses closely, we picked up on the tendencies that analysts have to come out and defend stocks they have buy ratings on, or try to create a pile-on for stocks they have a negative rating on. When we see what happens in the next slide, it appears that these analysts were out trying to prevent more selling pressure on the stock. On Monday, November 1st, 2021, a report is released saying 2/3 of all homes that Zillow bought are now worth less than what they paid for them. On Tuesday, the next day, Zillow's stock dropped 20%. After market hours that day, Zillow released earnings and announced they were exiting the iBuying business entirely and were laying off 25% of their employees. On Wednesday, the stock dropped another 20% from 85 to 65.50. Part of the issue Zillow probably ran into was that in order to satisfy the market's lofty expectations, they needed to juice the volume of transactions. To do that in a highly competitive real estate market, they had to offer private sellers more for their homes to keep them from listing their home with an agent the traditional way. Then when the residential real estate market stopped appreciating 5% per month over the summer and into the fall, the lack of discipline on pricing really hurt them. In the days following the announcement, analysts significantly reduced their price targets on Zillow. You can see how valuations and opinions backed by overly optimistic market narratives rather than fundamentals and realistic long-term growth projections can reverse really quickly. Barring a significant change, these analysts are likely to continue lowering their price targets over the coming months. What can make a company go from being valued at $14 billion to $52 billion back down to $14 billion, all within an 18-month time period? Stock market narratives. Zillow is a good business, but the lofty valuations weren't based on realistic revenue and earnings projections. Thanks for watching. We hope you enjoyed this presentation and that it has provided some value to you.